Good afternoon, everyone. Thank you very much for making the time to join us today as we discuss the importance of stakeholder management when trading performance is expected to deteriorate. We are thankful to the MGAA for giving us this opportunity to present. As restructuring professionals, this is a subject that's very close to our hearts and an area we spend a lot of time. And so we chose this subject because managing stakeholders can make a very big difference to the outcomes and the optionality when trading does deteriorate. So we at Grant Thornton have spent significant time representing MGAs, brokers, carriers, lenders, and even the FCA when trading has deteriorated. So we will be drawing on all of those experiences as we take you through the presentation today. Presenting today are myself, Brad Chadwick. I'm a partner in the Financial Services Restructuring Group. My colleague Andrew Charters is an insolvency practitioner in the group. He's currently an administrator for Brighthouse and for Wonga. And my colleague Rob Bayliss heads the financial modeling practice within the firm. So you'll be hearing from each of us. Some housekeeping. First thing to say is there's no planned fire alarm during this presentation. So if there's any fire alarm noise in your house, may I suggest you check your kitchen. All participants are on mute for the duration of the call. The webinar is being recorded. If you'd like to ask a question, please use the chat functionality within Zoom, and we will have a Q&A session at the end of the presentation. And then after the call, feedback forms will be sent out with a link to collateral and the presentation. So the agenda we're going through today is we'll talk through what some of the impacts of COVID-19 may be on MGAs and why we anticipate that may result in a deterioration of trading for some MGAs, identification of stakeholders, their concerns, and what managing that may look like. And then because this presentation is a CPE qualifying presentation, we will be taking through a couple of tools that we use when we're working with entities whose trading is lagging. And we will close by having some comments on directors and officers' responsibilities. The agenda and the learning objectives are broadly the same, and as such I won't take you through those, but we do need to touch on them and reiterate them at the end to make sure you qualify for CP. So the first section is to talk about the impact of COVID-19 on MGAs. So on the 5th of May, Grant Thornton issued its piece of thought leadership called The Impact of COVID-19 on MGA. And we wrote the article because we'd seen a lot of press around the impact that COVID-19 was having on the carrier market. However, we had not seen a corresponding amount of attention on the MGA market. What is quite, I suppose, a relief to us is we've now seen a lot more of that publication, including the Insurance Times article that came out. You can't have your rate and eat it too, and they touched on many of the same themes that we did. So really breaking it down into themes, what is the likely impact of COVID-19 on the market, and then so what? So from a revenue perspective, in the short term, we're expecting to see some revenue pressures on MGAs, both where there are specific product lines and also where there are and product lines would be events, travel, aviation, or if they are focused on distributing products to sectors such as the leisure sector, pubs, restaurants, gyms, where the facilities are now closed and are not being used, and as such it would be reasonable for those policyholders to come back and ask for midterm adjustments. In that scenario, it is likely that those will be issued and there will be a commission clawback to the carrier. In the medium term, there's more than likely going to be a recession. There's a consensus view of that. And with the recession will be a reduction in economic activity and lower revenues. And then similarly, some carriers have seen significant increase in loss ratios on certain books of business. These loss ratios may impact people's contingency or profit shares, which could be another area where revenue is impacted. As an MGA, we view you as the central part of an ecosystem. And as the central part in the ecosystem, we think the impact on you from your counterparts is something that really needs to be considered. So on one side, you'll have the carriers whose products you are responsible for selling. So what's happening to the carriers in this market? Some of them are out already raising capital, which we've seen. Others are sufficiently capitalized that it's not a problem for them. But in both scenarios, it is probable that coming out of COVID-19, there will be a hardening of rates, which will be good news for the MGA sector. But we have seen in previous cycles that carriers use this as an opportunity to do strategic reviews of what products they want to sell through which distribution channels. And it is likely that the MGA market will see winners and losers. And the losers may have schemes cut. They may, in the worst scenario, actually lose binding capacity. And how would you respond to that? On the other side of the ecosystem are the policyholders and the brokers. How equipped are you as an MGA if some of your brokers go out of business? And can you withstand the complications of now having to deal directly with the public if that book of business doesn't find a new home? So those are some of the counterpart issues that we think are likely to impact the MGA market, both of which would actually result in increased costs for the MGA. So you'll have the increased costs of dealing with broker fallout, you'll have the increased costs of looking for additional capacity or changing schemes. And then the other area that we are mindful of is the FCA and the regulators were laser focused on operational resilience already. And we have anecdotally heard that they have written to a number of MGAs to actually ask about the operational resilience experience and their plans. So coming out of this, both the regulators and the carriers will be focused on MGA operational resilience, which if you are already performing well is probably not a concern. However, if you are an MGA that has had operational challenges, it's likely that that focus will result in additional pressures on you to remedy them, which may result in additional expenditure. So what, I suppose, is the point that, well, for well-run MGAs that have been stable and have not got significant debt on the balance sheet, these will just be typical headwinds and a typical economic cycle. However, there are going to be those entities out there for whom this is a more than just headwinds, and for which the reduced revenue, the increased costs may cause sufficient challenges that the stakeholders start to get concerned. So as such, we will turn to the next slide. Who are the stakeholders that we think MGAs should be thinking about, and what are their concerns really? So the stakeholders we identify as needing to be addressed proactively go from left to right: shareholders. So shareholders will be focused on EBITDA, and the reason they're focused on earnings before interest, tax, depreciation, amortization is that is typically one of the primary drivers in value. So they'll be looking at that to focus on value. If they've done a recent acquisition, is the transaction value going to hold over the future period? Shareholders also sit on the board, and they have the ability to change management. So they're going to be looking within the business to look at the plans that management have put in place to address performance, and they're going to be looking to make sure those plans are credible. And they will want to see robust financial analysis supporting those plans. The next set of stakeholders for MGAs that have debt are the lenders. And having represented lenders recently, they were crystal clear that at the time they put the loan in place, they had done an assessment of the financial performance of the business, so they knew what the expected EBITDA was, and they got comfortable with that. They'd had a look at the balance sheet position, they got comfortable with that, and therefore they'd come up with a risk rating for the business and issued loans accordingly. When that deteriorates, the lender covenant position is impeded, and as such they are looking either to get the loan paid down to de-risk it, or they will be looking for higher interest or other payments. And this is entirely reasonable given that they're putting their capital to risk and they have their own stakeholders to manage. So in the event that trading is going to deteriorate, is thinking through, okay, right, so if that's the lender's concern, what can we do to address those concerns? We identify capacity providers or carriers as another key stakeholder to be mindful of. While they're probably less concerned about your trading and your EBITDA, they are going to be very concerned about your viability and the support you're going to get from your shareholders and your lenders. And as such, they will be looking to you to demonstrate that you have their confidence. The reason being comes back to the ecosystem we discussed. if the MGA were to fail, does the capacity provider through its primary insurance business have the arms and legs and the infrastructure in place to step into the MGA's shoes and deal with the brokers and the TPAs? So really for them, it's a risk mitigation exercise. And as and when schemes have to be renewed or binders renewed, they will be looking to make sure they're making wise decisions when they do that. And then we've identified the FCA. Typically when we're in these situations, we view the FCA's concerns as twofold. Policyholder detriment, first and foremost, and second, disruption to the market. So they're looking to management and the wider ecosystem to make sure that in the event of a downturn, there are plans in place such that the policyholders continue to make claims, have their claims paid, do midterm adjustments, make complaints, and so on, and that in the event of an MGA failure, that it's not going to disrupt the entire market. And then on the right-hand side, we've identified the following stakeholders as critical stakeholders. However, typically these stakeholders are less likely to see the inner workings of the MGA, and as such, you would communicate with them differently to the others. So that's what we have on this slide is identifying the stakeholders. I suppose the question then is, so you've identified the stakeholders, you know what the concerns are, you've identified that your trading is likely to deteriorate, what do you do? Well, really, the first thing to do is, as a management team, is to sit down and work out what you actually think trading will look like. On a realistic basis, with realistic assumptions, what is revenue going to be? And based on that, if you can make cost adjustments or flex, what are your costs going to be? And therefore, what is your EBITDA or cash generated going to be? So it's crystal clear that that work needs to be done. And then based on that, are you going to be fine? You're generating sufficient cash that you can fund your debt service payments and you're not breaching covenants? Or are you not going to generate sufficient cash where that's a problem? So you will need to go to either your shareholders to ask for additional equity, or go to your lenders and ask for either a covenant waiver or forbearance. So that's really what we are talking about, preparing you for those conversations in a credible way. So I'm going to transition now over to my colleague, Rob Bayliss, who's going to take you through preparing integrated three-statement models, which are really a fundamental tool in preparing for these conversations.
Thank you, Bradley. So hi, everybody. Picking up from what Bradley was saying, so we've talked about the need to proactively engage with your stakeholders and take to them effectively a business plan. So a forecast, as Bradley said, of what do you think your revenue and profit and cash generation is going to be. And importantly, for that to be supported by a degree of robust financial analysis. And putting together a financial model, or we'll talk about a three-statement model, is an absolutely key step in having that to hand and driving data-driven insight into the information that you are sharing. So I'm going to canter through what we mean by that, what your stakeholders would expect to see, the benefits for you of doing so, and some tips around the process and how you work as a team, and some practical tips of how to do it. Next, please, Brad. So we've referred to an integrated three-statement model. So what do we mean? So a financial model it's a tool, it's a forecasting tool. It's typically prepared in Excel, so it's a big shiny spreadsheet that you will use to forecast the future trading performance of the business, and in particular to forecast it built up from a set of assumptions and key data points in a way that you can tell the story of the commercial assumptions you are making and show the build-up. And then you can change them and see what happens. Why do we need to see the three statements, and why together? Because as Brad has said, different stakeholders are going to have different requirements and different expectations of the information about the future performance of the business that they're going to need through profit and cash and balance sheet measures. And that creates a full integrated together picture of the future business, and doing the three together in the same spreadsheet creates a very essential control and cross-check. And when we say integrated, I'll come to a second in a nice picture for that, but it means that they're held together, they're internally consistent, and there's no cheating, there's no balancing numbers. And pieces of the calculations which you'd expect to be interlinked are interlinked through the formulas in the spreadsheet, so that when revenue goes up, then the variable costs go up and associated working capital changes and things cascade through. Next, please, Brad. So, and I talked about having those three financial statements integrated together and interconnected. So in this very sketchy schematic of how a model may be put together, with a flow from assumptions data through calculations into your financial statement output sheets, we want to really rigidly try to tie together the parts where the profit and loss, cash flow and balance sheet should talk to each other. So the earnings number that comes partway down the profit and loss forms the start of the cash flow. They are wired together, and the cash number on the balance sheet is driven by the movements in the cash flow statement itself. So everything's held together. Every journal, every accounting entry that is put through what the model says the accounts are going to do has a home, and it all balances. Next, please, Brad. So that's what we think you should set about doing. What's the benefit of you doing so? Well, as Brad said, you got to meet the expectations of the people you're taking this information to. But putting that plan and putting that set of numbers together, ultimately, more than anything, is a thought process. And the model is a tool that enables that process and gathers all that commercial information into one place. Building a model in a nice, clear, transparent way, and I'm going to explore a little bit more what we mean by that in a second, creates a tool that then gives you a very clear link from the assumptions you're making all the way through to the outcomes. So that as you tell the story, you have a credible and clear flow from the assumptions you're making to the numbers that actually come out of it. And it becomes a source of truth that you're very able to share with other people and explain and defend when your assumptions are challenged. The model built flexibly is also a tool to really drive insight into the risks and the different ways that the future can pan out for the business. So your assumptions are clearly separated, and you can change them, and you can quantify the impact and see what happens. And my colleague Andy in a minute will talk about the importance of understanding different scenarios and sensitivities to the business plan. And when you change those data points in your model, it cascades all the way through the financials and through the ratios and testing covenants and all the measures that your stakeholders are interested in. And lastly, I'd suggest that if you put a model together in this way, and hopefully many of you may already have one, that you can create something that you can regularly roll forward and update for more recent performance, and you can keep reforecasting, and you can keep supporting the dialogue. Next, please, Brad. So that's what we think you should set out to do as a team. A few pointers on how to go about it, and I'm not going to go through every point on this flow, but what is important is think of it as a process. What I would strongly suggest you don't do is find the most Excel literate accountant in your building and lock them in a room and let them out once they've done a model. Because putting a model together is supporting the business plan, supporting the process, is a team exercise which needs senior buy-in and direction. And I'd advise you to as a team, to take the chance to go through that as a little bit of a process, and the importance of planning up front. What are you going to need? So you don't just open Excel and start typing. So work out what level of detail to go to and what flexibility will be needed, what cuts of your revenue build up, which channels to show, and making sure that you think you can have the data to fill it in. Get a plan in mind, put the model together, and try to use good Excel habits, which I'll come back to in a second, and gather the data from your management accounts and from your team at the same time. Shove it into the model, get a first cut, and look at it as a team and as a senior team. Are you happy with what that's showing? Is that the story you want to share and that you can stand behind? Polish it up and get it understood, get it approved. Your stakeholders are going to want to know that the board approved and they stand behind these figures. And then with that base case locked down, use the model as a tool to understand the impact of different scenarios, so you can take the alternative visions and what you as a management team would do in those situations to the stakeholders to present. Next, please, Brad. And finally from me, because I live and breathe doing wonderful things in Excel, I thought I would also share, and you will have someone putting some very clever bit of kit together in a spreadsheet, some practical tips on good Excel habits, good practice around trying to make sure things are as simple and easy to follow and clear as possible, and avoiding complexity, making sure things are only in one place so they can easily be found and changed. And if anyone's interested, I can supply quite a bit more on this and some work that we've done with, for example, the Institute of Chartered Accountants on best practice in this area. And that's all from me. I'll hand you over to my colleague and a partner in our restructuring practice, Andy, who's going to talk, I think, about IBRs.
Yes, thanks, Rob. And thank you also, Brad. So just picking up, I guess, on both what Brad and Rob have just been saying, Brad was talking about the importance of communication with stakeholders, particularly in the face of kind of trading headwinds, and particularly when those headwinds can potentially be strong enough to actually start to call into question maybe the viability of the business. And then Rob's just walked through the three-statement model and the approach to take to that and planning of that. And what I'm now going to do is talk about an independent business review, or an IBR. And I guess, that communication with your stakeholders, it needs to be based on accurate data. Why? It builds trust, and it provides the basis for more robust decision making. And actually, the decisions that you then derive are more easily and readily able to be bought into by your stakeholders. So, Brad, if you can just click on one slide, please. So an IBR, independent business review, is a proven restructuring tool, and it's highly effective in supporting those stakeholder discussions and stakeholder management generally through a downturn in trading. So in this short section, I'm going to just explore what an IBR is, what the benefits of one are, and when you might use them, or therefore when they're helpful. Next page, please, Brad. So an IBR kind of does what it says on the tin. It's an independent review of the business. But what does that really mean? So for me, independence is a crucial word. The IBR is carried out by independent professionals, and therefore that allows the report to be and be seen to be objective, and it provides independent third-party challenge to management assumptions, and it brings a fresh perspective to business plans. So when we say it's a review of the business, what do we mean by that? And I thought maybe the easiest way of doing that today, in the time available, was to set out an overview of a scope of work from an IBR. And it's an IBR we have done in respect of an MGA. Clearly, for the purposes of today, it's anonymized and made relatively high level to fit the formats, but it is very much based on a real-life IBR scope, and I thought that was perhaps the easiest way to talk through and contextualize this for the audience today. And just before we get into that, I think the important thing just to note to start with is, because this is a review of the business, the IBR is not designed to produce a business plan. It reviews a business plan. So the work and more of that Rob has just described needs to be done in advance of the IBR. So the business plan is prepared. As a management team, you have a sense of where you want to go, and then this is a review process of that for you and for your stakeholders. So now if we just turn to the slides and the scope areas, the first kind of scope area, and a lot of this needs to be adapted and made very much bespoke to the specific situation at the time, but this is generally the flow you would follow. And the first section, the background to the business section, may on first glance appear a little bit unnecessary, possibly. So why do we have that in there? I think it's important just to step back and realize the purpose of a tool, one of which is to communicate with stakeholders. And stakeholders will not know your business, perhaps existing stakeholders will not know your business perhaps as well as you think they know your business. And certainly in the case of banks, of financial institutions, in the event of a downturn in trading, it is highly possible that your account, as it were, will be transferred to the workout team within a bank, and they will certainly not have the background and history to the business. And so setting this out at the start of a report is really important to ground people in essential facts and understanding, and contextualizes the rest of the report. There are also some kind of important points in here that this section flushes out, and what, you know, as an example, one of those is the ownership structure. In essence, you might think, well, that's relatively simple, but in a lot of PE-backed transactions, it is not that simple, and particularly as regards not just the ownership structure but the capital structure. Where does the debt sit in the structure? You know, in a PE owned structure, that's often a couple of layers above the operating entity, but it needs to be clear and it needs to be mapped out for people so people understand the situation. And we certainly worked on a project relatively recently where it wasn't entirely clear which entities, which parties had security over which assets, and also who had the right to appoint an administrator if that was going to be necessary. You know, so establishing some of those key facts, hopefully you can see, is really important, and that's why you have that right up front in the IBR. You then move on to historical trading. And again, this is partly around providing context, and it's partly around answering the question as to why we are where we are in this situation. And it also, I guess, as a final point, it helps you, back to the context point, it helps contextualize and helps test the forecasting that will have been done, as you'll see, as part of a review as well. And the type of thing we would start to look at in this section is some of the key metrics or KPIs. So, for example, producers. How many producers? What is the number of producers in the business? When did they join? What portfolio of clients do they have? How much revenue generated by the producers? Is there a reliance, for example, on one or two or even one individual producer for a significant portion of the business's revenue? Does that need to calibrate how we think about some decisions moving forward? And then another key piece of information for stakeholders in respect to an MGA, and back to Brad's point that he was making earlier about the ecosystem, it is trying to get an understanding of that ecosystem in this section a little bit as well. So, you know, what is the distribution channel and what dependencies are there on the distribution channel for key lines of businesses and volumes? Again, does the business rely on 3 or 4 brokers for a majority of its revenue? And we'd work on high concentration areas in particular to try to tease out those risks for stakeholders. And carrier dependency is another area that we'd look to very much focus on. Again, and you know, in literally every conversation we have with private equity houses, carrier dependency is one of their top questions. So you'd look to answer it in this section of the report. Brad, if you just flick on one more slide, please. Following on, and you'd look at, you typically look at the kind of cost base or the expenses on a historic basis of the business. Now, MGAs, as you are well aware, have a relatively stable cost base. So your efforts here would likely to be focused on, say, again, producer incentive numbers or employee numbers, headcount numbers, and how they've moved over time. Have they been growing in anticipation of a growth in revenue and volumes, for example? Just moving through the scope a little bit and turning to cash. Now, liquidity and cash, given the likely context of an IBR, is going to be a key focus for people. And from an MGA, in an MGA situation, you know, we would very much be focusing on cash, but also the cash management process, the bordereau process. We'd want to understand in detail how the MGA manages its cash flows, because we know certain MGAs manage their cash flows differently. For example, some will do weekly reconciliations to free up cash. Others will look at cash in trust, premium receivable, and premium payable, and then effectively work out a surplus from there to use as free cash. So our review is very much going to look at that process, go very much into the detail of the process, and then really start to drill down into the quality of the earnings in terms of how do the earnings generate and turn into cash. We'd then move on to reviewing the current financial position, i.e. the balance sheet, the current balance sheet position of the company. And again, particularly with an MGA, that's likely to focus on premium receivable, and premium receivable in particular around the aging of premium receivable. You know, does the business have certain one or two brokers who regularly pay late? Let's interrogate the data, have a look at that trend. Maybe management are already aware of that, but stakeholders aren't. So let's tease that out and make it clear to people. We'd also, again, just keeping moving through without going into every item, but trade creditors and analysis of trade creditors. What we're talking about there is trade creditors. We're not talking about premium or financial kind of creditors. So we're talking about really understanding the creditor position you have with your landlord, with HMRC, with IT suppliers, and they're all critical suppliers who, whilst may have not made the kind of matrix that Brad showed at the start of the presentation, actually can have quite an influence on a restructuring process as things develop, particularly people like HMRC, but IT suppliers and others critical. So let's understand our position. Where are they? What is the balance? How does that compare to historics? And then, Brad, I think if you can turn on one more slide, please. So having looked at the kind of the background to the business, the current financial position, understood the cash flows historically, and the cash management process generally, a lot of the focus in an IBR is going to be on the forecast projections for business moving forward. And just tying back in and to reiterate, it is a review, so that kind of modelling that Rob has talked about will have been done by this point. And so what we'll be looking at here is very much drilling down into the assumptions. What assumptions have you made about your forecast to give the results that you're projecting? And are those realistic? What's underpinning those? And as an example, and this is not a current client, but if we were to say, deal with an MGA whose one of its lines of business was selling learner driver policies. We'd want to understand the assumptions around the revenue from that stream, and so we'd probably go down to the DVLA website and actually have a look at the number of driving tests that are being kind of carried out year on year to see if we can analyse a trend, and then tie that back into the assumptions that management are making about the kind of policyholder population or potential policyholder population, and does it make sense? And it's that level of detail and that level of scrutiny that you'd look to go to in an IBR. And now the forecast then is the idea behind that is it will summarise, particularly for funders, the exposure that those funders have to the business, how that's going to evolve. And then the other thing that we would do is have a stream of work where we would sensitise those forecasts to in essence ensure that you have a kind of downside case and an upside case, often with management's case being the base case somewhere in the middle. And the sensitivities we would apply would probably in reality focus perhaps more on the vulnerabilities, because people are more likely to be interested in kind of understanding what downside risks are, but it would not exclude potential upsides, because it's not a balanced approach and you can't get that range like that. And it would definitely also look at what mitigating actions might be available for management to take if some of those vulnerabilities started to materialise. That then range then gives stakeholders a summary of the impact on covenant compliance, the liquidity position of a business over a range of possible outcomes, which is really valuable then to take into the conversations about how we move forward from this position. Brad, if you want to click on, please. So that is in essence what an IBR is. So it is an independent, that's important, review of the business. So the benefits in IBR, and I don't intend to spend long on this slide at all, are hopefully relatively clear having kind of gone through the scope. But I think it can be summed up in the three kind of main words or three main phrases here: increased knowledge, transparency, and credibility. Increased knowledge, and that's not just for the stakeholders, increased knowledge for management because of our independent, robust, third-party challenge to forecast. Transparency, that's really critical in building trust that's going to be needed for those difficult conversations, and providing the level of detail and scrutiny that an IBR involves, and then reporting on that to stakeholders is incredibly transparent and really goes a long way to building trust, all of which then feeds into the overall credibility of the proposal, which was likely to follow an IBR, and the credibility of the business plans themselves, because they've been subject to independent and objective assessment. Brad, one more, please. So when would you use an IBR? So I think you would use an IBR typically at the point in which you are anticipating making a request of your stakeholders, particularly in the face of a downturn in economic conditions. The other point to note is that stakeholders will often request an IBR if you make such a request without having already done the IBR yourself. And in that situation, it can feel somewhat like it's being imposed on you. And I would encourage you to kind of reflect on, actually, even if it does feel a little bit like that at the start, you can still derive a lot of benefit from the process. So I think that's what I wanted to cover on IBR. So I will pass back to Brad.
Great, thanks. And just a reminder that if you've got questions, there is a Q&A at the end of the presentation. So you can put those questions in the chat box and we will make sure we answer them. So the last two sections really are to talk through short-term cash flow forecasts, which are an important tool, and then directed officers' responsibilities. So there are really three questions. What is a short-term cash flow forecast? Who uses one, and what is the value of it? And what are some best practice tips to prepare one? So essentially, short-term cash flow forecast is typically a 13-week forecast where your cash receipts and your cash payments are projected either on a daily or a weekly basis. And a good short-term cash flow forecast will also have a put and take for your receivables and your payables. And what you're watching for is either depletion of the receivables, so there's no income beyond the 13 weeks, or a buildup of your payables which you can't meet. So that's typically what a short-term cash flow forecast is. It is 13 weeks because that covers a full quarter of trading, and most large payments will come due at least once in a quarter. So that's the tool. Who uses short-term cash flow forecasts and what is the value? I think the best way to answer this question is really from experience. Short-term cash flow forecasts are a management tool. So they're there for the CFO and the CEO and the COO to manage their stakeholders, be that their board, their shareholders, or their lender. It is not unusual for a lender to want sight of it if it has been prepared, or even to mandate that it is prepared if there are going to be liquidity constraints. I was in a former life CFO and CEO of a PE-backed insurance vehicle. We owned MGAs. We owned a technology business. We had a lot of premium finance, amongst other things. The PE fund who owned us was very aggressive, and were committed to growing really quickly for 4 years and then exiting. So our mandate, as given to us by our board, was to hire producers across the country, put teams around them, put offices around them, put the technology around them. As you will know, bringing on a salesperson, and from our experience, a really good salesperson may get to cash flow break even in 3 months. An average one takes 6 months to start generating cash about equal to their costs. Some take 9 months, and some never do. So in a stable business where you suddenly start adding a lot of producers, you very quickly move to a board-approved cash burn situation. And that's what we did, with full board approval and with cash in the bank for that exact purpose. I sat down at a board meeting in June, and I presented to our board saying, if we add the producers as requested to deliver our sales goals, we will run out of cash around about December, and I won't be able to make the December payroll. And that was a discussion we had in June. The board signed it off. We were okay with that because we had two mitigations. One is we used to do the insurance for a very large outdoor sporting event. They used to renew their policy every year, and the policy used to drop around $2 million of commission in our P&L. So I knew there was a $2 million of cash coming in December. And then the other thing is we were in negotiations to a couple of transactions which would have necessitated an equity raise and a debt raise. which again would have solved our liquidity issues. So we traded through July, we traded through August, we traded through September. Two of the acquisitions fell apart because they weren't a good fit. And we get to the September board meeting, and I'm looking at a cash crunch in December, and I am looking at an inability to meet payroll, which is clearly it's a make or break moment for the organization. So as a restructuring professional, I then chose to step back and build a 13-week forecast for a number of reasons. One, I wanted to put the discipline into our organization of monitoring all receipts and payments. And then two, I wanted to make sure I was spotting intra-week and intra-day peaks and troughs. Because it's all very well to look at a point in time at the end of the month, but if your cash cycle is such that you release your commissions to yourself at the end of the month, then you're missing the week before. So we had to inject the discipline of really monitoring that on a daily basis. In the scenario I talk about, we both did a transaction, so we raised debt and equity, and we renewed the policy, so cash was fine and we traded through. But as the CFO and COO with board responsibilities, one of the reasons I was able to sleep at night is I had done the rigorous analysis to make sure there weren't surprises coming around the corner that I wasn't prepared for. And I think someone without my background may not have been as comfortable as I was going into that scenario. So how did I go about preparing it? I took the income statement as projected, which was very much based on prior year income. So what were my renewal rates? What was last year's income this month? What are the big accounts coming up? What is my degree of confidence that that is going to come in, and how tightly can I pinpoint that in a period of time? So I'm tracking that. We similarly used to have a TV screen where I could see every single day what each producer bound. So I knew exactly how much commission was generated on a day-by-day basis. So I was able to have real-time insights into our cash coming in. And then on a cost basis, I took the last year's payables ledger, and really I was looking for trends of large recurring payments going out. What day did they go out? Rent, IT, insurance, payroll, and then looking for large unexpected things to make sure they weren't recurring or surprises. And really we mapped it. And then every week we tracked our inflows and our outflows. I approved every cost that went out the business, and we had full visibility. So that's an example of a short-term cash flow. They're very, very time-consuming to prepare, and they're very time-consuming to manage, and they get a lot more accurate every week you get in. And they really are a tool when there are liquidity constraints. So, for instance, we recently just completed a project for a lender, and we expect the borrower to have some liquidity constraints probably around March next year. So they will, in my view, need to either raise more funds before then, or I would expect them to start looking at intra-week cash flow movements starting in January to make sure there aren't any surprises. So that's really the background to the short-term cash flow forecast. If you are in the zone where you have to watch your cash that tightly, it probably makes sense to understand what your directors and officers' responsibilities are. So we've included a brief overview of that. Over to you, Andrew.
Thanks again, Brad. As Brad says, this is just a brief overview of the directors and officers' responsibilities. I think maybe worth just starting with wrongful trading, because it's been headline grabbing, including yesterday's kind of announcement from a government on a new bill on insolvency reform. And it's also always a hot topic when we're advising boards. So, and directors are rightly concerned about the potential personal liability in case they breach this provision of the Insolvency Act. So what is wrongful trading? Well, in essence and in short, it's a claim that an insolvency practitioner can bring against directors for continuing to trade whilst a company is insolvent and causing financial harm to creditors. And that's what it is, but it's been suspended by the government as a result of the COVID-19 crisis. And I think that's a really helpful step. Let's be clear, the suspension of wrongful trading sends a positive message to directors. It gives them some reassurance. And it comes up in every conversation we have with boards. So it's clearly a helpful step because it's at the top of boards' minds in a financially stressed situation. However, in my view, and it's not just my view, it's kind of generally held view in the restructuring community, that helpfulness, if you like, only goes so far. Directors continue to have a number of other duties and responsibilities which have not been suspended. So maybe just very briefly, the place to start then is solvency. We're talking here, and Brad's alluded to it really, around a situation where a business might be insolvent. So insolvency is defined in the Insolvency Act, and there's two basic tests. There's the cash flow test and the balance sheet test. The balance sheet test taking out first is simply put, are your liabilities greater than your assets? And the cash flow test is the business unable to pay its debts as they fall due? But to engage the duties we're about to talk about in a moment, and tying back to what Brad was saying about short-term cash, a company doesn't necessarily need to be insolvent in that strict sense that just kind of briefly outlined. It just has to be in what's described as the zone of insolvency. And that's a pretty subjective term and concept. And I think in essence it refers to a period where the company is financially troubled. And if you look at some of the legal commentary, that's kind of some of the language they use as well. And so what's the impact of that? Well, when the company is in this zone of insolvency, the directors of that company must look to protect the interests of creditors as their primary goal or objective. Whereas normally you'd probably say the primary goal or objective is to protect the interest of shareholders. So there's a shift in the burden of the duty for the directors from shareholders to creditors. And so fiduciary duties under the Companies Act have not been suspended, they continue. And therefore, despite the suspension of wrongful trading, for businesses in financial trouble, directors must still have a duty to protect the interests of creditors and take appropriate action. And failure to do so could lead to potential claims being brought against by directors by an insolvency practitioner. Still, it would be under a different heading than wrongful trading, but there is still a risk. And further, I suppose, just to obviously reiterate and make clear, there are other duties that directors and officers have, particularly in a regulated environment that the MGAs operate in, and they will also continue in the current situation. And in particular in the zone, and Brad has already touched on this, regulators, the FCA in particular, but regulators will be very focused and expect boards to be equally laser focused on minimising policyholder detriment. And so I get the key point for me from this slide, and we didn't want to spend too long on it, is that wrongful trading suspension is helpful, but directors have broader fiduciary duties that continue, and there's some kind of potential steps to mitigate some of these risks listed there. I don't propose to go through them today. So I will hand back to Brad. Brad.
Thank you, Andrew. Great. Apologies, I was on mute. So just a brief recap of our learning objectives. And then if anyone's asked any questions, we will get to the questions. So the learning objectives were to go through what is an integrated three-segment model, why is it important, and how is it prepared. The same for an independent business review and a short-term cash flow forecast, and what are directors and officers' responsibilities in the zone of insolvency. So we will now take some questions. The first question that has come in is actually, looks like it's for Rob. It says, thank you for the insights on modeling. Who in the organization is the best person to own the process of building a model, and why?
Okay, yeah, sure. Happy to address. Good question. And embraces something that's really important for me, that it is a process that is owned. It's not just subcontracted to the most junior person who happens to be good with a spreadsheet. It would need heavy engagement with your finance function, and probably, if not being developed or built by an accountant, certainly needs heavy input from your accountants. So it would normally be covered by for example, your financial controller, or if you have a financial planning officer, or potentially someone with a treasury role. Important to try to make sure that person has the support framework around them. They themselves need to have the time made available in their day job, because putting a model together with the flexibility we talked about is not a 5-minute task. So making sure they have that support framework around them, and the senior direction on what to do, and absolutely encourage them to look around for resources, there's a lot of online resources on how to get even smarter at doing things in Excel.
Great. Thanks, Rob. Then I suppose another question that's come in, and Andy, is for one of us. Why don't we both have an answer and see what we think? In negotiations between lenders, management, and shareholders, what are the key negotiating points? So what's up for play? It's an interesting question, actually.
So I think so if I start with maybe not necessarily a negotiating point, but an important consideration is around, given that matrix, and you might pick up on something slightly differently, but I think one of the things you need to establish early on is what we would term as whether value breaks. So who's got an economic interest in the outcome of a restructuring negotiation is a really important question to answer very early on in the piece, because if there's still equity value in the business, then the shareholders are clearly going to be really engaged and potentially motivated to support. Whereas if there's no equity value and the value effectively resides with secured lenders, then that creates a different negotiating dynamic. Brad, I don't know if you've got anything to add.
Yeah, I think in that scenario, the other point to make that becomes interesting is the question was aimed at shareholders, lenders, and management. There is another stakeholder here, which is the capacity provider, because don't forget they have the dependence on the entity as well. And I think, and this is where I really encourage management to think through who their stakeholders are and to make sure they build those rapports. So these are constructive negotiations. In the most recent engagement we've done, the capacity provider has extended capacity for a period of time beyond which they had intended to do, and at a higher gross written premium level. The lender has forbeared, albeit for higher interest costs. So the financing costs will be higher, and it'll see them recovering their funds slightly quicker if forecasts are met. But the equity holders have not been diluted, so they retain their interest in the entity and would see a return on the back end, which would allow management to retain control of the business and continue to operate it. So I think that's the same thing as you, Andrew. It's where does a value break, but it goes back to what each of their concerns are.
Yeah, agreed.
Okay, we only have another one question. So if anyone else got questions, please do submit them. Do submit them now. Let me go through. The next question was, and again, I think Andrew touched on this, but it was who asked for an IBR to be done? Andrew touched that, and then how long does an IBR take?
Two good questions. I think so. I did briefly touch on it, but just to an IBR can be your company can decide to commission an IBR, or in the alternative, it can be one of the lenders, or alternatively any other stakeholder, frankly, who's got a financial interest or who will be asked to do something as part of a process. So we have done in various different sectors, we have done where you have large complicated capital structures, we've done IBRs on behalf of a range of financial creditors, not simply your kind of traditional banks. So it can be any number of different creditors, I think, who can commission one. And then how long does it take? It depends obviously on the scope of work and the size of the organisation. You can do them relatively quickly in a matter of a couple of weeks, or they can take a month or two. I think the one we've done recently probably took about a month and a half to produce the kind of final report.
Okay, great. So I think on that note, we have answered all the questions, and we are very grateful to have had your attention, and thank you very much for joining us. And thanks, Ben and Teresa, for giving us the opportunity.
Thank you.
Indeed, thank you.